Question 1. Research into the operational efficiency of a large health insurance provider has identified significant delays in claims processing and member inquiry resolution. The executive team is pushing for immediate process optimization to reduce operational costs and improve customer satisfaction scores. Which of the following strategic approaches best aligns with regulatory requirements and ethical considerations for a health insurance provider? Option A. Aggressively reducing the overall claims approval rate by implementing stricter, arbitrary thresholds for claim submissions, irrespective of individual medical necessity or policy coverage details. Option B. Outsourcing all claims processing functions to an external vendor with minimal oversight, assuming the vendor will manage all operational and compliance aspects independently. Option C. Automating the entire claims approval process using broad, preset algorithms that bypass human review for all claim types, regardless of complexity or potential for exceptions. Option D. Implementing a data-driven review of claims processing workflows to identify specific bottlenecks and inefficiencies, followed by targeted improvements to streamline pre-authorization, claims adjudication, and appeal processes, ensuring all changes are validated against policy terms and regulatory mandates. The correct answer is D. Implementing a data-driven review of claims processing workflows to identify specific bottlenecks and inefficiencies, followed by targeted improvements to streamline pre-authorization, claims adjudication, and appeal processes, ensuring all changes are validated against policy terms and regulatory mandates. Explanation. This scenario is professionally challenging because it requires a health insurance provider to balance the imperative of cost containment with the ethical and regulatory obligation to ensure access to necessary medical services for its members. The pressure to optimize processes for efficiency can inadvertently lead to decisions that compromise member care or violate regulatory mandates designed to protect policyholders. Careful judgment is required to ensure that process optimization efforts are aligned with the overarching goals of providing quality health coverage and adhering to all applicable laws and guidelines. The correct approach involves a comprehensive review of existing claims processing workflows to identify bottlenecks and inefficiencies, followed by the implementation of targeted improvements that enhance speed and accuracy, without compromising the integrity of coverage decisions or member experience. This approach prioritizes data-driven analysis to pinpoint specific areas for enhancement, such as streamlining pre-authorization procedures or improving denial appeal processes. Regulatory justification stems from the principle of acting in the best interest of the insured, ensuring fair claims handling, and maintaining operational compliance with health insurance regulations that mandate timely and accurate processing of claims and member inquiries. Ethical considerations demand that efficiency gains do not come at the expense of patient well-being or access to care. An incorrect approach that focuses solely on reducing the number of approved claims without a thorough review of medical necessity or adherence to policy terms is ethically unsound and likely violates regulatory requirements for fair claims adjudication. This approach prioritizes cost reduction over member benefits and could lead to wrongful denials, thereby undermining the trust and purpose of health insurance. Another incorrect approach that involves automating claims approval based on broad, unverified algorithms without human oversight or consideration for individual case complexities risks systemic errors and noncompliance. This can lead to the denial of legitimate claims or the approval of inappropriate ones, both of which have significant regulatory and ethical implications, including potential violations of consumer protection laws and fiduciary duties. A further incorrect approach that involves outsourcing claims processing to third-party vendors without robust oversight and quality control mechanisms can lead to a loss of control over process integrity and compliance. This can result in regulatory breaches if the vendor fails to adhere to the provider's standards or applicable laws, potentially exposing the provider to significant penalties and reputational damage. Professionals should employ a decision-making framework that begins with a clear understanding of the regulatory landscape and ethical obligations. This involves conducting a thorough assessment of current processes, identifying specific areas for improvement through data analysis, and developing solutions that are both efficient and compliant. Continuous monitoring and evaluation of implemented changes are crucial to ensure ongoing adherence to regulatory standards and ethical principles, always prioritizing the well-being and rights of the insured. Question 2. To address the challenge of accurately assessing an applicant's health status for a new health insurance policy while adhering to strict regulatory guidelines that prohibit unfair discrimination, a senior underwriter has received an application that includes a history of a chronic but well-managed medical condition. The underwriter is considering how to proceed with the assessment. Which of the following approaches best aligns with regulatory compliance and professional ethics in this situation? Option A. Requesting detailed medical records and consulting with a medical advisor to objectively assess the current impact and prognosis of the chronic condition on the applicant's health and potential claims, using this information to apply standard underwriting guidelines. Option B. Assuming the chronic condition will inevitably lead to significant future claims and adjusting the premium accordingly without further investigation, based on general industry knowledge of such conditions. Option C. Approving the policy immediately without further inquiry into the chronic condition, to avoid any perception of discrimination or undue scrutiny, and to expedite the application process. Option D. Denying coverage outright based on the presence of the chronic condition, citing potential future risks without a detailed, individualized assessment of the applicant's specific health status and management of the condition. The correct answer is A. Requesting detailed medical records and consulting with a medical advisor to objectively assess the current impact and prognosis of the chronic condition on the applicant's health and potential claims, using this information to apply standard underwriting guidelines. Explanation. This scenario is professionally challenging because it requires a health insurance provider to balance the need for accurate risk assessment and premium setting with the ethical and regulatory obligations to avoid discriminatory practices and ensure fair access to coverage. The core tension lies in interpreting and applying health status information in a manner that is both actuarially sound and compliant with consumer protection laws. Careful judgment is required to distinguish between legitimate underwriting based on objective health factors and prohibited discrimination based on protected characteristics or pre-existing conditions, depending on the specific regulatory framework governing the PHIAS exam. The correct approach involves a thorough review of the applicant's medical history, focusing on objective health indicators and their direct relevance to the underwriting process as defined by applicable regulations. This approach prioritizes gathering all necessary information to make a fair and compliant assessment, ensuring that any underwriting decisions are based on established guidelines and do not violate prohibitions against unfair discrimination. This aligns with regulatory mandates that often require insurers to base coverage decisions on objective health criteria while preventing arbitrary or discriminatory practices. An incorrect approach that relies solely on broad assumptions about certain medical conditions without specific, objective evidence of their impact on insurability would be professionally unacceptable. This could lead to unfair denial of coverage or discriminatory premium adjustments, violating regulations designed to protect consumers. Another incorrect approach that involves ignoring significant pre-existing conditions to expedite coverage would also be problematic, as it could lead to adverse selection and financial instability for the insurer, potentially violating solvency regulations and good faith obligations. Furthermore, an approach that uses applicant-provided information without independent verification, especially if it appears incomplete or misleading regarding health status, could expose the insurer to regulatory scrutiny for failing to conduct due diligence in underwriting. Professionals should employ a decision-making framework that begins with a clear understanding of the specific regulatory requirements governing health insurance underwriting and consumer protection in their jurisdiction. This involves consulting internal underwriting guidelines, relevant statutes, and regulatory pronouncements. When faced with ambiguous information, the professional should seek clarification, gather additional objective data, and consult with compliance or legal departments. The decision-making process should prioritize fairness, transparency, and adherence to legal and ethical standards, ensuring that all actions are defensible and serve the best interests of both the applicant and the insurer within the established regulatory boundaries. Question 3. Analysis of a situation where a physician, who is part of a physician-hospital organization, PHO, is faced with a patient requiring a specialized diagnostic procedure. The PHO has a preferred vendor for this procedure, which offers the PHO a slightly higher reimbursement rate than other available vendors. The physician believes an alternative vendor, while not part of the PHO's preferred network, offers superior technology and potentially a more accurate diagnosis for this specific patient's complex condition. The physician is aware that aligning with the PHO's preferred vendor could contribute to the PHO's overall financial performance, which indirectly benefits the physician's participation in the organization. What is the ethically and professionally mandated course of action for the physician? Option A. Recommend the alternative vendor that offers superior technology and potentially a more accurate diagnosis, prioritizing the patient's best medical interests. Option B. Inform the patient about the PHO's financial incentives and preferred vendor structure, allowing them to make the final decision based on this information. Option C. Recommend the PHO's preferred vendor, but subtly downplay the benefits of the alternative vendor to guide the patient towards the preferred choice. Option D. Recommend the PHO's preferred vendor to support the organization's financial goals, as the reimbursement difference is minor and the PHO's success benefits all members. The correct answer is A. Recommend the alternative vendor that offers superior technology and potentially a more accurate diagnosis, prioritizing the patient's best medical interests. Explanation. This scenario presents a professional challenge due to the inherent conflict of interest that can arise within a physician-hospital organization, PHO. PHO, by their nature, integrate physicians and hospitals, aiming for improved efficiency and quality of care. However, this integration can create pressure to prioritize services or referrals that benefit the PHO's financial interests over the optimal patient care decisions, especially when financial incentives are tied to PHO performance. The ethical dilemma lies in balancing the PHO's objectives with the physician's fiduciary duty to the patient. Careful judgment is required to ensure that patient well-being and independent medical decision-making remain paramount. The correct approach involves a physician prioritizing the patient's medical needs and best interests above any potential financial implications or directives from the PHO. This means recommending the most appropriate treatment or referral, regardless of whether it aligns with the PHO's preferred providers or financial targets. This approach is ethically and regulatorily justified by the physician's fundamental duty of loyalty and care to the patient, which supersedes any contractual obligations to an organization like a PHO. Professional guidelines and ethical codes for physicians consistently emphasize patient autonomy and the physician's role as the patient's advocate. An incorrect approach would be to steer the patient towards a service or provider within the PHO solely based on the PHO's financial incentives or preferred network, even if a more suitable or cost-effective option exists outside the PHO. This constitutes a breach of the physician's ethical duty and could violate regulations concerning patient steering and anti-kickback statutes if financial inducements are involved. Another incorrect approach would be to disclose the PHO's internal financial pressures or incentives to the patient, as this could unduly influence the patient's decision-making and erode trust in the physician-patient relationship. It shifts the burden of organizational financial management onto the patient, which is inappropriate. The professional decision-making process for similar situations should involve a clear hierarchy of priorities. Patient welfare first, followed by adherence to professional ethical standards, and then consideration of organizational policies. Physicians should regularly review their PHO agreements to understand potential conflicts of interest and establish clear protocols for managing them. When in doubt, seeking guidance from professional medical associations, ethics committees, or legal counsel specializing in healthcare law is advisable. Transparency with patients about their care options, without revealing sensitive organizational financial details, is also crucial. Question 4. The investigation demonstrates that a health insurance agent, while meeting with a prospective client to discuss coverage options, subtly steered the conversation towards a particular high-commission product that offered a slightly better commission structure for the agent, even though a different, lower-commission product was a more direct and cost-effective fit for the client's stated health concerns and budget. The agent did not explicitly disclose the commission difference or the potential for a more suitable, albeit less lucrative for the agent, alternative. Which of the following approaches best reflects the agent's professional and regulatory obligations in this situation? Option A. Recommend a product that offers a moderate commission and is generally suitable for a broad range of clients, without delving deeply into the specific nuances of the prospective client's unique health situation. Option B. Recommend the product that offers the highest commission, assuming the client will benefit from the coverage provided, and only disclose commission details if directly asked by the client. Option C. Recommend the product that the agent is most familiar with and has had the most success selling, regardless of whether it is the absolute best fit for the client's specific circumstances. Option D. Recommend the product that best aligns with the client's documented health needs and financial capacity, fully disclosing any commission structures or incentives that might be perceived as influencing the recommendation. The correct answer is D. Recommend the product that best aligns with the client's documented health needs and financial capacity, fully disclosing any commission structures or incentives that might be perceived as influencing the recommendation. Explanation. This scenario presents a professional challenge due to the inherent conflict of interest that can arise when an agent or broker has a vested interest in recommending a particular health insurance product, potentially at the expense of the client's best interests. The PHIAS exam emphasizes the agent's fiduciary duty and the ethical obligations to act in the client's best interest, which are paramount in health insurance sales. Careful judgment is required to navigate situations where personal gain might influence professional recommendations. The correct approach involves prioritizing the client's needs and ensuring full disclosure of any potential conflicts of interest. This aligns with regulatory frameworks that mandate agents and brokers to act with honesty, integrity, and in a manner that best serves the client. Specifically, regulations often require agents to assess the client's needs, recommend suitable products, and disclose any commissions or incentives that might influence their advice. This approach upholds the principle of utmost good faith and prevents misrepresentation or deceptive practices. An incorrect approach that involves recommending a product solely based on higher commission, without a thorough needs assessment, constitutes a breach of fiduciary duty and ethical standards. This can lead to clients being sold policies that do not adequately cover their health needs, resulting in financial hardship and potential regulatory sanctions. Another incorrect approach, failing to disclose a financial incentive tied to a specific product, is a direct violation of transparency requirements and can be considered deceptive. This erodes client trust and undermines the integrity of the insurance industry. Recommending a product that is clearly unsuitable for the client's health status or financial situation, even if it offers a good commission, is also a failure to act in the client's best interest and can lead to significant client dissatisfaction and regulatory scrutiny. The professional decision-making framework for such situations should involve a clear process. 1. Needs assessment. Thoroughly understand the client's health status, financial situation, and coverage requirements. 2. Product suitability. Identify products that genuinely meet these identified needs. 3. Disclosure. Transparently communicate all relevant information, including policy details, limitations, benefits, and any personal financial incentives associated with recommendations. 4. Client best interest. Make recommendations that unequivocally serve the client's best interests, even if it means foregoing a higher commission. 5. Regulatory compliance. Ensure all actions adhere strictly to the PHIAS exam's specified regulatory framework and ethical guidelines. Question 5. During the evaluation of a health insurance plan's financial reserves following an unexpected surge in claims due to a novel infectious disease outbreak, the plan administrator identifies a significant shortfall. The administrator is considering several immediate actions to address this financial strain. Which of the following approaches best aligns with the regulatory framework and ethical obligations governing health insurance operations? Option A. Immediately implement a temporary suspension of all non-emergency claims processing and initiate a review of all previously approved claims to identify potential overpayments. Option B. Discreetly reduce the reimbursement rates for healthcare providers for all services rendered during the period of the outbreak, without notifying providers or seeking regulatory guidance. Option C. Inform policyholders that due to the unforeseen circumstances, all future claims will be subject to a significant co-payment increase, without prior consultation or approval from regulatory bodies. Option D. Proactively communicate the financial challenges to the relevant state insurance department, explore all available reinsurance options, and begin developing a transparent plan for policyholders regarding potential premium adjustments or benefit modifications, subject to regulatory approval. The correct answer is A. Immediately implement a temporary suspension of all non-emergency claims processing and initiate a review of all previously approved claims to identify potential overpayments. Explanation: this scenario presents a professional challenge due to the inherent conflict between a health insurer's contractual obligations to its members and the potential for financial strain caused by an unforeseen, widespread health event. Navigating this requires a deep understanding of both legal and ethical responsibilities. The insurer must balance its duty to provide covered benefits with the need for financial solvency to continue serving all its members. The correct approach involves transparent communication with regulatory bodies and policyholders, coupled with a proactive strategy to manage the financial impact. This includes exploring all available reinsurance options, seeking regulatory approval for any necessary adjustments to premiums or benefits, if permissible under the policy and regulations, and engaging in good faith negotiations with providers. This approach is ethically sound because it prioritizes honesty, fairness, and the long-term viability of the insurance plan, thereby upholding the insurer's fiduciary duty to its members and adhering to principles of responsible financial management as mandated by health insurance regulations. An incorrect approach would be to unilaterally deny or significantly delay claims without proper regulatory oversight or justification. This would violate the terms of the insurance contracts and likely contravene specific provisions within health insurance laws that protect policyholders from arbitrary claim denials. Another incorrect approach would be to conceal the financial difficulties from regulators and policyholders, hoping the situation resolves itself. This constitutes a failure of transparency and could lead to severe penalties for regulatory noncompliance, as well as a breach of ethical duty to inform stakeholders of material issues. Furthermore, attempting to shift the financial burden onto policyholders through undisclosed or unauthorized means would be a direct violation of consumer protection laws and ethical principles of fair dealing. Professional decision-making in such situations requires a systematic process. First, a thorough assessment of the financial impact and its root causes. Second, a comprehensive review of all contractual obligations and applicable regulations. Third, consultation with legal and actuarial experts. Fourth, open and honest communication with regulatory authorities. And finally, the development and implementation of a strategy that balances financial prudence with ethical and legal responsibilities to policyholders. Question 6. The monitoring system demonstrates that a significant portion of a health insurer's investment portfolio, primarily consisting of corporate bonds, has experienced a substantial and prolonged decline in market value due to a widespread economic downturn. Analysis indicates that this decline is not temporary, and the insurer is unlikely to recover the full cost of these investments. Insurer's chief financial officer is considering several options for how to report the situation in their upcoming financial statements. Which of the following approaches best aligns with the regulatory framework and accounting principles governing financial reporting for health insurers in the United States? Option A. Reclassify the impaired corporate bonds to a different investment category that allows for a more favorable accounting treatment, such as held to maturity, to avoid immediate loss recognition. Option B. Defer the recognition of the impairment loss, classifying it as a temporary decline, and continue to carry the investments at their amortized cost, with disclosure of the market value in the footnotes. Option C. Recognize an impairment loss in the current financial reporting period for the decline in value that is considered non-recoverable, adjusting the carrying value of the investments accordingly, and recording the loss on the income statement. Option D. Disclose the significant decline in market value and the potential for future losses in the footnotes to the financial statements, but do not adjust the carrying value of the investments on the balance sheet or recognize a loss on the income statement in the current period. The correct answer is C. Recognize an impairment loss in the current financial reporting period for the decline in value that is considered non-recoverable, adjusting the carrying value of the investments accordingly, and recording the loss on the income statement. Explanation: scenario analysis. This scenario is professionally challenging because it requires the financial analyst to interpret complex financial reporting data within the specific regulatory confines of the PHIAS exam's jurisdiction, which is assumed to be the United States for the purpose of this question. The challenge lies in discerning the appropriate accounting treatment for a significant, non-recurring item that impacts the insurer's financial health and solvency, while adhering strictly to U.S. generally accepted accounting principles, GAAP, and relevant insurance regulatory guidance. Misinterpreting or misapplying these principles can lead to materially inaccurate financial statements, potentially misleading stakeholders, and violating regulatory compliance. The analyst must exercise sound professional judgment to ensure transparency and accuracy in reporting. Correct approach analysis. The correct approach involves recognizing the impairment loss in the period it is identified, as required by U.S. GAAP, specifically ASC 320, Investments, Debt, and Equity Securities, and ASC 326, Credit Losses. For health insurance entities, this also necessitates consideration of how such an impairment impacts statutory accounting principles, SAP, and solvency margins, as mandated by state insurance departments. The impairment loss should be recognized as a reduction in the carrying value of the investment and recorded as a loss on the income statement. This approach ensures that the financial statements reflect the true economic value of the insurer's assets and provides a faithful representation of its financial performance. Adherence to these principles is critical for regulatory compliance and maintaining stakeholder confidence. Incorrect approaches analysis. One incorrect approach would be to defer recognition of the impairment loss until a future period, hoping for a market recovery. This violates the principle of conservatism and the requirement for timely recognition of losses under U.S. GAAP. Such deferral would misrepresent the insurer's current financial position and profitability, potentially leading to regulatory scrutiny and penalties. Another incorrect approach would be to reclassify the impaired security to a different investment category without proper justification or adherence to reclassification rules under ASC 320. This could be an attempt to avoid recognizing the loss, which is a form of financial statement manipulation and a violation of accounting standards. A third incorrect approach would be to disclose the impairment only in the footnotes without recognizing the loss on the income statement and balance sheet. While disclosure is important, it does not substitute for the required accounting recognition of the loss. This would fail to provide a complete and accurate picture of the insurer's financial condition. Professional reasoning. Professionals in financial reporting and analysis must adopt a systematic approach to complex situations. This involves 1. Identifying the relevant accounting standards and regulatory requirements applicable to the specific entity and jurisdiction. 2. Thoroughly analyzing the nature and impact of the transaction or event. 3. Applying the identified standards and regulations to the analyzed facts. 4. Exercising professional skepticism and judgment to ensure the accounting treatment is appropriate and reflects economic reality. 5. Documenting the rationale for the accounting treatment. 6. Disclosing relevant information transparently to stakeholders. In this case, the professional must prioritize adherence to U.S. GAAP and relevant insurance regulations over any potential desire to present a more favorable, albeit inaccurate, financial picture. Question 7. The risk matrix shows a client in their late 50s with a moderate risk tolerance, a desire to leave a legacy to their children, and a growing concern about potential future long-term care, LTC needs. They have a substantial home equity, but are hesitant about the premium costs and potential loss of premiums if LTC is not utilized, associated with traditional standalone LTC insurance. The client is seeking alternatives that can address both potential LTC expenses and preserve some form of inheritance. Which of the following approaches best addresses the client's multifaceted needs and concerns within the regulatory framework for advanced health insurance studies? Option A. Recommend a life insurance policy with a long-term care rider, allowing for the acceleration of the death benefit to cover LTC expenses while retaining a death benefit for beneficiaries if LTC is not needed. Option B. Propose the purchase of a short-term annuity designed to provide income for a fixed period, which the client can then use to pay for any immediate LTC costs. Option C. Advise the client to take out a reverse mortgage on their home to create a liquid fund for potential LTC expenses, with the understanding that this will reduce the inheritance for their children. Option D. Suggest the client establish a dedicated savings account or a conservative investment portfolio to accumulate funds specifically for future LTC needs. The correct answer is A. Recommend a life insurance policy with a long-term care rider, allowing for the acceleration of the death benefit to cover LTC expenses while retaining a death benefit for beneficiaries if LTC is not needed. Explanation: this scenario presents a professional challenge because it requires an advisor to navigate complex client needs for long-term care, LTC, planning beyond traditional insurance, while adhering to regulatory obligations and ethical duties. The client's specific financial situation, health status, and risk tolerance necessitate a tailored solution, moving beyond a one-size-fits-all approach. The advisor must demonstrate a thorough understanding of various LTC funding mechanisms and their suitability, ensuring the client makes an informed decision that aligns with their best interests and regulatory guidelines for product suitability and disclosure. The correct approach involves recommending a diversified strategy that integrates a life insurance policy with a long-term care rider. This is the most appropriate because it addresses the client's desire for a death benefit while providing a mechanism to fund potential LTC needs. Regulatory frameworks, such as those governing insurance product sales, mandate that advisors recommend solutions that are suitable for the client's circumstances. A life insurance policy with an LTC rider offers a degree of flexibility and can be more cost-effective than standalone LTC insurance for some individuals, particularly if they do not end up needing long-term care, as the death benefit can still be passed on. Ethically, this approach prioritizes the client's dual objectives and provides a robust, albeit potentially complex, solution. Recommending a reverse mortgage as the sole solution for LTC funding is an incorrect approach. While a reverse mortgage can provide access to home equity, it is primarily a debt instrument that accrues interest and reduces the equity available to heirs. It may not be suitable for all clients, especially those with limited home equity or who wish to preserve their home for their beneficiaries. Regulatory failure would occur if the advisor did not adequately assess the client's overall financial picture and the long-term implications of such a debt. Suggesting a simple savings account or investment portfolio without specific LTC features is also an incorrect approach. While these can accumulate funds, they lack the structured benefits and potential tax advantages often associated with dedicated LTC solutions. The risk of outliving savings is significant, and without a dedicated LTC product, the client may deplete their assets before their LTC needs are met. This fails to meet the advisor's duty to recommend appropriate financial products for the stated need, potentially violating suitability regulations. Proposing a short-term annuity to cover immediate LTC expenses without considering the long-term nature of care needs is another incorrect approach. Annuities are designed for income streams, but a short-term one would likely be insufficient for the potentially decades-long duration of LTC. This approach neglects the long-term financial planning aspect crucial for LTC and could lead to the client exhausting their funds prematurely, creating a significant financial burden. The professional decision-making process should involve a comprehensive client needs analysis, including a detailed review of their financial situation, health status, family history, and personal preferences regarding LTC. The advisor must then research and present a range of suitable alternatives, clearly explaining the benefits, drawbacks, costs, and regulatory implications of each. Transparency and clear communication are paramount, ensuring the client understands the chosen solution and its alignment with their long-term goals. Question 8. Comparative studies suggest that the accuracy of diagnosis-related group, DRG, assignment significantly impacts healthcare reimbursement. A health insurance claims reviewer encounters a case where the assigned DRG appears to be inconsistent with the documented severity of the patient's illness and the complexity of the procedures performed. Which of the following approaches represents the most appropriate best practice for the reviewer in this situation? Option A. Reassign the DRG based on the most favorable reimbursement outcome for the provider, assuming the initial coding was a conservative estimate. Option B. Request a revised coding submission from the provider based on a general understanding of DRG logic, without specific reference to the patient's clinical documentation. Option C. Accept the initial DRG assignment without further investigation, trusting the accuracy of the submitting facility's coding department. Option D. Conduct a comprehensive review of the patient's medical record, including all physician documentation, nursing notes, and operative reports, to verify the principal diagnosis, comorbidities, and complications that influence the DRG assignment, and consult official coding guidelines if discrepancies are identified. The correct answer is A. Reassign the DRG based on the most favorable reimbursement outcome for the provider, assuming the initial coding was a conservative estimate. Explanation. This scenario presents a professional challenge because it requires a nuanced understanding of how diagnosis-related groups, DRG, are applied in health insurance claims processing, specifically within the regulatory framework governing the professional health insurance advanced studies PHIAS exam. The core of the challenge lies in ensuring that the DRG assignment accurately reflects the patient's condition and treatment, thereby preventing both underpayment and overpayment, which have significant financial and ethical implications for providers and payers. Careful judgment is required to navigate potential discrepancies between clinical documentation and the coding assigned for DRG purposes, ensuring compliance with established coding guidelines and payer policies. A correct approach involves a thorough review of the patient's medical record to verify the accuracy of the principal diagnosis and all significant comorbidities and complications, CC, that influence the DRG assignment. This approach is best professional practice because it directly aligns with the principles of accurate and ethical coding, which are foundational to fair reimbursement. Regulatory justification stems from the need to adhere to coding standards, e.g., ICD-10-CM for diagnoses, ICD-10-PCS for procedures in the U.S. context, which is the assumed jurisdiction for PHIAS, unless otherwise specified, and payer-specific guidelines that dictate how DRGs are determined. Ethically, this ensures that providers are reimbursed appropriately for the resources consumed, and that patients receive the correct level of care without financial burden due to coding errors. An incorrect approach would be to accept the initial DRG assignment without independent verification, especially if there are indications of potential miscoding or incomplete documentation. This failure to scrutinize the assignment risks financial impropriety, either by accepting an overpayment, which can lead to audits and penalties, or by allowing an underpayment, which can impact provider revenue and potentially lead to resource allocation issues. Another incorrect approach is to solely rely on the billing department's interpretation of DRG rules without consulting clinical documentation or coding experts. This bypasses the essential link between clinical reality and the coded representation, violating the principle of accurate data capture. A further incorrect approach is to adjust the DRG assignment based on desired reimbursement outcomes rather than clinical accuracy. This is a direct ethical violation, as it prioritizes financial gain over truthful representation of patient care and is contrary to all regulatory frameworks governing healthcare billing. The professional decision-making process for similar situations should involve a systematic review of the patient's chart, cross-referencing clinical documentation with assigned codes and the resulting DRG. When discrepancies arise, engaging with clinical staff for clarification and consulting official coding manuals and payer policies are crucial steps. This iterative process ensures that the DRG assignment is both clinically sound and compliant with all applicable regulations and ethical standards. Question 9. Stakeholder feedback indicates a desire for a health insurance plan that offers a broad network of providers, allows for out-of-network care with higher cost sharing, and provides a balance between employer cost control and employee flexibility. Which of the following plan types best aligns with these stated preferences? Option A. A plan that combines features of both in-network and out-of-network coverage, requiring a primary care physician referral for in-network specialist care, but allowing direct access to out-of-network providers with significant cost implications. Option B. A plan with a low premium and deductible, designed to be paired with a health savings account, offering significant tax advantages but with a limited network of preferred providers. Option C. A plan that offers a wide selection of in-network providers, permits out-of-network care at a higher deductible and coinsurance, and does not typically require referrals for specialist visits. Option D. A plan that requires referrals from a primary care physician for specialist visits and restricts coverage to a defined network of providers. The correct answer is D. A plan that requires referrals from a primary care physician for specialist visits and restricts coverage to a defined network of providers. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of different health insurance plan structures and their implications for both providers and patients, all within the specific regulatory framework of the PHIAS exam jurisdiction. Misinterpreting these plan types can lead to incorrect recommendations, impacting patient access to care, provider reimbursement, and compliance with health insurance regulations. Careful judgment is required to align the plan characteristics with the stated stakeholder needs. The correct approach involves accurately identifying the plan that best balances cost-effectiveness for the employer with provider choice and cost-sharing for employees, aligning with the principles of efficient and accessible healthcare delivery as envisioned by the regulatory framework. This plan typically offers a degree of flexibility in provider choice while maintaining cost controls through network arrangements. An incorrect approach would be to recommend a plan that severely restricts provider choice without a clear justification for cost savings that outweighs the loss of access for employees. This could violate regulations aimed at ensuring adequate access to care and patient choice where feasible. Another incorrect approach would be to suggest a plan that offers unlimited provider choice without any cost-sharing mechanisms, which would likely be unsustainable from an employer's perspective and could lead to non-compliance with cost containment provisions within the regulatory framework. Recommending a plan solely based on a single feature, such as a low deductible, without considering the overall structure and its impact on network access and out-of-pocket maximums, would also be an incorrect approach, failing to provide a holistic solution that meets diverse stakeholder needs. Professionals should employ a decision-making framework that begins with a thorough understanding of the employer's objectives, e.g., cost containment, employee satisfaction, and the employee's needs, e.g., provider access, predictable costs. This involves analyzing the core features of each plan type, HMO, PPO, PAS, HDHP, in relation to these objectives and needs, considering the regulatory requirements for each plan type within the PHIAS jurisdiction. The decision should then be made by selecting the plan that offers the most appropriate balance, supported by a clear rationale that addresses both cost and access considerations, and adheres to all applicable regulations. Question 10. Investigation of the potential impact of aggressive cost reduction strategies on the financial solvency and regulatory compliance of a health insurance provider. A financial manager is considering several options. Which approach best aligns with the regulatory framework and ethical obligations for health insurance financial management? Option A. Significantly reduce the budget for actuarial analysis and claims review departments to achieve substantial cost savings, believing that internal expertise can be supplemented by external consultants on an as-needed basis. Option B. Implement cost-saving measures that primarily focus on reducing operational expenses, such as streamlining administrative processes and renegotiating vendor contracts, while ensuring that actuarial reserves remain robust and capital adequacy is maintained in accordance with risk-based capital requirements. Option C. Prioritize immediate premium rate reductions to capture market share, even if this requires a temporary reduction in the company's surplus to offset the lower revenue, with the expectation of future profitability to replenish reserves. Option D. Focus cost-saving efforts on delaying the recognition of incurred, but not yet reported IBNR, claims to improve the current financial statement, with the intention of adjusting reserves in future periods when the financial situation is more stable. The correct answer is B. Implement cost-saving measures that primarily focus on reducing operational expenses, such as streamlining administrative processes and renegotiating vendor contracts, while ensuring that actuarial reserves remain robust and capital adequacy is maintained in accordance with risk-based capital requirements. Explanation. This scenario presents a professional challenge because it requires a health insurance financial manager to balance the immediate financial pressures of a company with the long-term solvency and ethical obligations to policyholders. The manager must navigate potential conflicts between short-term profitability and the fundamental responsibility to maintain adequate reserves and capital to meet future claims, all within the strict confines of regulatory requirements. Careful judgment is essential to avoid actions that could jeopardize the company's financial stability or lead to regulatory sanctions. The correct approach involves a comprehensive assessment of the impact of proposed cost-saving measures on the company's financial health and regulatory compliance. This includes evaluating the adequacy of reserves, the sufficiency of capital, and the potential for adverse selection or market conduct issues. Specifically, it requires a thorough understanding of the regulatory framework governing health insurance solvency, such as the National Association of Insurance Commissioners, NAIC, Solvency Modernization Initiative (SMI), and state-specific risk-based capital (RBC) requirements. These regulations are designed to ensure that insurers can meet their obligations to policyholders. Implementing cost-saving measures without a rigorous analysis of their impact on these key financial metrics would be a direct violation of the spirit and letter of these regulations, potentially leading to regulatory intervention, fines, and damage to the company's reputation. An incorrect approach would be to implement cost-saving measures solely based on their immediate impact on the bottom line, without considering their effect on reserve adequacy. This fails to acknowledge the regulatory requirement to maintain reserves sufficient to cover all future claims, including those that have been incurred but not yet reported (IBNR). Such an approach could lead to an underestimation of liabilities, a violation of statutory accounting principles, and potential insolvency. Another incorrect approach would be to reduce investment in actuarial and claims review functions to cut expenses. This directly contravenes regulatory expectations for robust financial oversight and accurate financial reporting. These functions are critical for ensuring that reserves are properly calculated and that claims are paid appropriately, both of which are subject to regulatory scrutiny. Undermining these functions creates a significant risk of financial misstatement and regulatory noncompliance. A third incorrect approach would be to prioritize short-term premium rate reductions to gain market share without a corresponding actuarial justification for the reduced rates. Health insurance regulations often require rates to be actuarially sound and not unfairly discriminatory. Implementing rates that are not supported by adequate reserves or projected claims experience could lead to financial losses and regulatory penalties for unfair trade practices. The professional decision-making process for similar situations should begin with a clear understanding of the company's financial position and its regulatory obligations. The manager should then identify all proposed cost-saving measures and systematically evaluate their potential impact on key financial indicators, including reserves, capital, and profitability, as well as their compliance with all applicable regulations. This evaluation should involve consultation with actuarial, legal, and compliance departments. The decision should be based on a holistic view that prioritizes long-term financial stability and policyholder protection, rather than short-term gains, ensuring that any implemented measures are sustainable and compliant. Question 11. The performance metrics show a slight increase in overall enrollment processing times, prompting a review of current operational procedures. Considering the regulatory framework for health insurance in the United States, which of the following approaches best aligns with the principles of serving special populations while maintaining operational efficiency? Option A. Reducing the availability of personalized enrollment assistance and focusing resources on digital self-service options to decrease overall processing costs. Option B. Prioritizing the processing of applications from individuals who are not identified as belonging to special populations to clear the backlog more quickly. Option C. Conducting a targeted review of enrollment and benefit access for individuals with pre-existing conditions and those from historically underserved communities, making necessary adjustments to ensure equitable access and compliance with federal and state mandates. Option D. Implementing a standardized, fully automated enrollment process for all applicants, with limited exceptions for complex cases, to expedite processing. Correct answer is D. Implementing a standardized, fully automated enrollment process for all applicants, with limited exceptions for complex cases, to expedite processing. Explanation. This scenario presents a professional challenge because it requires balancing the operational efficiency of a health insurance provider with the ethical and regulatory imperative to ensure equitable access to coverage for vulnerable populations. Specifically, focus on special populations, such as individuals with pre-existing conditions or those from low-income households, necessitates a nuanced understanding of their unique needs and the legal frameworks designed to protect them. The challenge lies in identifying and implementing strategies that are both compliant with regulations and genuinely supportive of these individuals, avoiding practices that could inadvertently create barriers to care. The correct approach involves a proactive and comprehensive review of enrollment processes and benefit designs specifically for special populations. This entails not only ensuring compliance with the relevant U.S. federal and state health insurance laws and regulations, e.g., Affordable Care Act provisions, state-specific mandates, but also actively seeking to identify and address potential gaps or disparities. This approach is best professional practice because it directly aligns with the ethical duty of care and the regulatory mandate to provide non-discriminatory access to health insurance. It demonstrates a commitment to serving all members equitably, which is a cornerstone of responsible health insurance provision. An incorrect approach would be to solely focus on streamlining enrollment for the general population without considering the specific needs of special populations. This could lead to overlooking or inadequately addressing the unique documentation requirements, communication preferences, or benefit complexities that individuals in these groups may face. Such an approach risks violating anti-discrimination provisions within health insurance laws and could result in disparate outcomes for vulnerable individuals, failing to meet the spirit and letter of regulatory requirements. Another incorrect approach would be to implement blanket policy changes that, while seemingly efficient, disproportionately impact special populations. For example, reducing the number of in-person enrollment assistance centers without considering the digital literacy or access challenges faced by some low-income individuals or seniors would be a significant regulatory and ethical failure. This demonstrates a lack of consideration for the diverse needs of the insured population and a potential violation of mandates to ensure accessibility. The professional decision-making process for similar situations should involve a multifaceted evaluation. First, thoroughly understand the specific regulatory landscape governing health insurance for special populations within the relevant jurisdiction. Second, engage in a needs assessment that actively seeks input from representatives of these special populations to understand their unique challenges and preferences. Third, develop and implement strategies that are demonstrably compliant with regulations and ethically sound, prioritizing accessibility and equity. Finally, establish ongoing monitoring and evaluation mechanisms to ensure that implemented strategies are effective and continue to meet the needs of all members, particularly those in special populations. Question 12. Process analysis reveals that a health insurance provider is considering implementing an AI-powered predictive analytics system to personalize health insurance plan offerings and adjust premiums based on predicted future health risks. What is the most responsible and regulatory compliant approach for the provider to take in this situation, considering the U.S. regulatory framework for health insurance? Option A. Rely solely on the AI system's output for all pricing and plan selection decisions, assuming the algorithm is inherently fair and unbiased, and deferring any external validation or oversight. Option B. Conduct a comprehensive bias audit of the AI algorithms, establish robust data privacy protocols aligned with HIPAA, and develop clear communication strategies to inform policyholders about the AI's use and its implications for their plans. Option C. Utilize the AI system to identify high-risk individuals and offer them less comprehensive or more expensive plans, while providing more attractive options to lower-risk individuals, without explicitly disclosing the AI's role in these decisions. Option D. Deploy the AI system immediately to gain a competitive advantage, focusing on maximizing profitability through personalized risk-based pricing, and address any potential regulatory concerns only if they arise. The correct answer is D. Deploy the AI system immediately to gain a competitive advantage, focusing on maximizing profitability through personalized risk-based pricing, and address any potential regulatory concerns only if they arise. Explanation. This scenario presents a professional challenge due to the rapid integration of artificial intelligence, AI, into healthcare, specifically in the context of health insurance. The core difficulty lies in balancing the potential benefits of AI-driven predictive analytics for risk assessment and personalized plan offerings with the imperative to uphold patient privacy, ensure fairness, and maintain transparency as mandated by relevant regulatory frameworks. Professionals must navigate the ethical considerations of data usage, algorithmic bias, and the potential for AI to exacerbate existing health disparities, all while adhering to the specific laws and guidelines governing health insurance in the United States. The correct approach involves a proactive and transparent engagement with AI technologies, prioritizing patient well-being and regulatory compliance. This means establishing robust data governance policies that align with HIPAA, Health Insurance Portability and Accountability Act, and other applicable U.S. privacy laws. It requires rigorous testing and validation of AI algorithms to identify and mitigate bias, ensuring that predictive models do not unfairly disadvantage certain patient populations. Furthermore, clear communication with policyholders about how AI is used in their insurance plans, including the types of data utilized and the decision-making processes, is crucial for building trust and fulfilling disclosure requirements. This approach upholds the principles of patient autonomy, non-maleficence, and justice, while adhering to the spirit and letter of U.S. healthcare regulations. An incorrect approach would be to implement AI-driven predictive analytics without adequate safeguards for patient data privacy. This could lead to violations of HIPAA, resulting in significant penalties and reputational damage. Another incorrect approach is to deploy AI models that have not been thoroughly vetted for bias. If these models lead to discriminatory pricing or coverage decisions, it would violate anti-discrimination laws and ethical principles of fairness, potentially leading to legal challenges and erosion of public trust. A third incorrect approach is to use AI to create overly complex or opaque insurance products that policyholders cannot understand, which could be seen as a failure of transparency and potentially violate consumer protection regulations. Professionals should adopt a decision-making process that begins with a thorough understanding of the specific AI application and its potential impact on all stakeholders, particularly patients. This involves a risk-based assessment, identifying potential regulatory, ethical, and operational challenges. Consultation with legal counsel, compliance officers, and ethics committees is essential. A phased implementation approach, with continuous monitoring and evaluation of AI performance, is recommended. Prioritizing patient consent, data security, and algorithmic fairness should be paramount throughout the development and deployment lifecycle of any AI solution in health insurance. Question 13. The review process indicates that a health insurance claim has been submitted for a complex surgical procedure. While the procedure is generally covered under the member's policy, the submitted documentation lacks specific details regarding the medical necessity for this particular patient, and there is a question about whether all pre-authorization steps were fully completed by the out-of-network provider. Claims handler is under pressure to process claims quickly to meet departmental performance metrics. What is the most appropriate course of action for the claims handler? Option A. Forward the claim to a supervisor for an immediate decision without conducting an initial review of the missing information. Option B. Request detailed medical records and documentation from the provider to substantiate the medical necessity of the procedure and confirm pre-authorization compliance, while informing the member of the pending review. Option C. Approve the claim as submitted to meet performance metrics, assuming the provider acted appropriately and the procedure is generally covered. Option D. Deny the claim immediately due to the incomplete documentation and potential pre-authorization issues to avoid further processing delays. The correct answer is B. Request detailed medical records and documentation from the provider to substantiate the medical necessity of the procedure and confirm pre-authorization compliance, while informing the member of the pending review. Explanation. This scenario presents a professional challenge because it requires balancing the insurer's financial interests with the patient's immediate health needs and the integrity of the claims process. The claims handler must navigate potential conflicts of interest and adhere strictly to regulatory guidelines to ensure fair and accurate claim adjudication. Careful judgment is required to avoid both underpayment, which could harm the patient and violate policy terms, and overpayment, which could lead to financial losses for the insurer and potentially fraudulent activity. The correct approach involves a thorough review of the submitted documentation against the policy's terms and conditions, and relevant regulatory requirements. This includes verifying the medical necessity of the services rendered, ensuring the provider is in network if applicable, and confirming that all pre-authorization requirements were met. If discrepancies or missing information are identified, the appropriate action is to request further clarification or documentation from the provider or member, clearly outlining the specific reasons for the delay and the information needed. This upholds the principle of fair claims handling, ensures compliance with policy provisions, and adheres to regulatory mandates that protect consumers by requiring transparent and timely claim processing. An incorrect approach would be to deny the claim outright without a clear, documented basis in the policy or regulations. This could lead to a violation of prompt payment laws and unfair claims settlement practices, as it fails to provide the insured with the benefits they are entitled to under the contract. Another incorrect approach would be to approve the claim without verifying the medical necessity or the provider's credentials, which could result in financial loss for the insurer and potentially facilitate fraudulent billing practices. This bypasses essential due diligence and regulatory oversight designed to prevent such occurrences. Proving the claim based on a vague understanding of the policy or a desire to expedite processing without proper verification also constitutes a failure to adhere to established claims adjudication procedures and regulatory expectations for accuracy and fairness. Professionals should employ a systematic decision-making framework that prioritizes adherence to policy terms, regulatory compliance, and ethical considerations. This involves 1. Understanding the policy contract thoroughly. 2. Identifying all relevant regulatory requirements for claim processing in the applicable jurisdiction. 3. Gathering and meticulously reviewing all submitted documentation. 4. Identifying any gaps or discrepancies and determining the appropriate course of action based on policy and regulation, e.g., requesting additional information, conducting further investigation, or approving/denying the claim with clear justification. 5. Communicating decisions clearly and promptly to all relevant parties. Question 14. The control framework reveals that the health insurance provider's finance department is developing its annual budget and quarterly forecasts. A junior analyst has proposed a method for forecasting future claims costs that primarily involves extending the average claims cost per member from the previous year by the projected inflation rate, with minimal consultation with the claims department regarding anticipated changes in utilization or new treatment protocols. What is the most appropriate course of action for the senior finance professional overseeing this process? Option A. Advise the junior analyst to focus solely on revenue forecasting for the upcoming period, as claims cost forecasting is inherently uncertain and best left to the actuarial department. Option B. Instruct the junior analyst to revise the forecasting method to incorporate detailed input from the claims department regarding expected utilization patterns, demographic shifts, and the impact of new medical technologies, and to also consider underwriting's input on policy changes affecting claims. Option C. Suggests that the junior analyst use a simple moving average of the last 3 years' claims costs to smooth out any annual fluctuation, without further departmental consultation. Option D. Approve the proposed forecasting method, as it provides a quick and straightforward estimate that can be used for initial planning purposes. The correct answer is D. Approve the proposed forecasting method, as it provides a quick and straightforward estimate that can be used for initial planning purposes. Explanation. The control framework reveals a potential discrepancy in the budgeting and forecasting process for a health insurance provider. This scenario is professionally challenging because it requires the professional to balance the need for accurate financial projections with the ethical obligation to present information transparently and avoid misleading stakeholders. The pressure to meet targets or present a favorable outlook can create a conflict of interest, necessitating careful judgment rooted in regulatory compliance and professional ethics. The correct approach involves a thorough review of historical data, consideration of current market trends, and engagement with relevant departments to understand operational impacts on future claims and premium income. This method ensures that the budget and forecast are grounded in realistic assumptions and reflect the most probable financial outcomes. This aligns with regulatory requirements for sound financial management and accurate reporting, as well as the ethical duty to act with integrity and competence. By incorporating diverse inputs and validating assumptions, the professional upholds the principle of due care and diligence, ensuring that financial projections are reliable for decision-making and stakeholder communication. An incorrect approach that relies solely on extrapolating past performance without accounting for significant market shifts or internal changes is professionally unacceptable. This failure to adapt projections to current realities can lead to inaccurate financial statements and misleading information for management and regulatory bodies. It violates the ethical principle of competence and the regulatory expectation of forward-looking financial planning that reflects the current operating environment. Another incorrect approach that involves selectively using data to present an overly optimistic forecast, ignoring potential adverse factors, is also professionally unacceptable. This practice constitutes a breach of integrity and honesty potentially misleading stakeholders about the financial health and future prospects of the organization. It contravenes regulatory mandates for fair representation and the ethical obligation to avoid misrepresentation. Furthermore, an approach that bypasses consultation with key operational departments, such as underwriting and claims, when developing the budget and forecast, is professionally unsound. This isolation of the budgeting process from operational realities leads to unrealistic assumptions about claim volumes, costs, and premium adjustments. It demonstrates a lack of due diligence and can result in forecasts that are not actionable or reflective of the business's true financial trajectory, thereby failing to meet professional standards of thoroughness and accuracy. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the objective. Clearly define the purpose of the budget or forecast. 2. Gather comprehensive data. Collect all relevant historical and current information. 3. Engage stakeholders. Consult with all relevant departments to gather insights and validate assumptions. 4. Analyze trends and risks. Identify and assess both positive and negative factors that could impact financial outcomes. 5. Develop realistic assumptions. Base projections on well-supported and defensible assumptions. 6. Document the process. Maintain clear records of data, assumptions, and methodologies used. 7. Review and validate. Seek independent review of the budget and forecast to ensure accuracy and reasonableness. 8. Communicate transparently. Present the final budget and forecast with clear explanations of assumptions and potential variances. Question 15. Assessment of how a health insurance professional should explain the financial responsibilities of a policyholder, specifically differentiating between the initial out-of-pocket amount paid before coverage activates, the ongoing percentage of costs shared after initial coverage, and the fixed fee paid for specific services, to ensure client comprehension and compliance with disclosure standards. Option A. State that the deductible is the monthly premium. Coinsurance is a fixed fee for specialist visits, and copayments are the percentage of costs paid after the deductible. Option B. Explain that the deductible is the amount paid before insurance begins. Coinsurance is the percentage of costs the policyholder pays after the deductible is met, and a copayment is a fixed fee paid for each covered service. Option C. Describe the deductible as a fixed fee paid for each doctor's visit, coinsurance as the monthly premium, and copayments as the amount paid before insurance coverage starts. Option D. Clarify that the deductible is the ongoing percentage of costs shared after initial coverage. Coinsurance is the amount paid before insurance coverage begins, and copayments are the monthly premium. The correct answer is B. Explain that the deductible is the amount paid before insurance begins. Coinsurance is the percentage of costs the policyholder pays after the deductible is met, and a copayment is a fixed fee paid for each covered service. Explanation. This scenario presents a professional challenge because it requires an insurance professional to accurately explain complex cost-sharing mechanisms to a client, ensuring the client understands their financial responsibilities under a health insurance policy. Misinterpreting or miscommunicating these concepts can lead to client dissatisfaction, disputes, and potential regulatory noncompliance. The challenge lies in translating technical insurance terms into clear, actionable information for a layperson. The correct approach involves accurately defining and differentiating deductibles, coinsurance, and copayments, and explaining how they apply sequentially or in conjunction with each other within the policy's framework. This ensures the client has a realistic understanding of their out-of-pocket expenses. Regulatory frameworks for health insurance, such as those governing consumer protection and disclosure, mandate that insurers provide clear and understandable information about policy benefits and costs. Ethically, professionals have a duty to act in the client's best interest, which includes providing accurate and transparent information to enable informed decision-making. An incorrect approach that conflates deductibles with copayments fails to recognize that a deductible is an amount paid before insurance coverage begins, while a copayment is a fixed amount paid for a covered healthcare service after the deductible has been met. This misrepresentation can lead the client to believe their out-of-pocket costs will be lower than they actually are, violating disclosure requirements and potentially leading to financial hardship for the client. Another incorrect approach that suggests coinsurance is a fixed fee for services ignores its nature as a percentage of the cost of a covered healthcare service. This misunderstanding can lead to significant underestimation of potential expenses, especially for high-cost medical services, and breaches the duty of accurate representation. A third incorrect approach that describes deductibles as a monthly premium payment fundamentally misunderstands the purpose of a deductible. Premiums are the regular payments made to keep the insurance policy active, whereas deductibles are amounts the insured must pay towards covered healthcare services before the insurer starts to pay. This misstatement is a clear failure of accurate disclosure and can lead to severe client confusion and distrust. Professionals should approach such situations by first thoroughly understanding the specific policy provisions related to cost sharing. They should then use clear, concise language, avoiding jargon, and provide concrete examples to illustrate how deductibles, coinsurance, and co-payments work together. A professional decision-making process involves prioritizing client understanding and transparency, adhering strictly to regulatory disclosure requirements, and maintaining ethical standards of honesty and integrity. Question 16. Upon reviewing an applicant's medical history, which includes a pre-existing condition that has been stable and well managed for several years with no recent complications, what is the most appropriate medical underwriting approach to ensure fairness and regulatory compliance? Option A. Impose a significantly higher premium without a detailed actuarial justification, based on a general apprehension about the applicant's future health. Option B. Decline coverage outright due to the presence of any pre-existing condition, regardless of its stability or management. Option C. Assign a standard risk classification based on the applicant's current health status and the established prognosis for their condition, utilizing actuarial data for similar cases. Option D. Offer coverage with substantial exclusions for any health issues related to the pre-existing condition, even if the condition is currently asymptomatic and well controlled. Correct answer is C. Assign a standard risk classification based on the applicant's current health status and the established prognosis for their condition, utilizing actuarial data for similar cases. Explanation. This scenario is professionally challenging because medical underwriting requires a delicate balance between accurately assessing risk to ensure the financial solvency of the insurance pool and adhering to ethical principles of fairness and non-discrimination. The underwriter must navigate complex medical histories and lifestyle factors without resorting to biased or arbitrary decisions. The PHIAS exam emphasizes a deep understanding of these principles within the relevant regulatory framework. The correct approach involves a comprehensive and objective assessment of all available information, focusing on established underwriting guidelines and actuarial data. This approach is ethically sound and regulatorily compliant because it ensures that risk is assessed based on quantifiable factors directly related to the likelihood and severity of a claim, rather than on subjective biases or protected characteristics. Adherence to these guidelines prevents adverse selection and maintains the integrity of the insurance product. An incorrect approach that relies on generalizations or stereotypes about specific medical conditions or demographic groups is ethically flawed and violates principles of fairness. It can lead to discriminatory practices, which are prohibited by regulations designed to protect consumers. Another incorrect approach that ignores significant medical history or lifestyle factors, even if seemingly minor, is professionally negligent. This failure to conduct a thorough risk assessment can result in mispricing the risk, potentially leading to financial losses for the insurer and unfair premium rates for other policyholders. A third incorrect approach that focuses solely on the applicant's perceived ability to pay premiums without adequately considering the medical risk is also professionally unsound. This prioritizes commercial interests over the core function of underwriting, which is risk assessment and management. Professionals should employ a decision-making framework that begins with a thorough review of all submitted information, followed by an objective application of underwriting manuals and guidelines. When faced with ambiguity or complex cases, seeking guidance from senior underwriters or medical advisors is crucial. This process ensures that decisions are consistent, defensible, and aligned with both regulatory requirements and ethical obligations to treat all applicants fairly. Question 17. Cost-benefit analysis shows that implementing a fully automated claim adjudication system for all claim types could significantly reduce processing costs. However, the regulatory framework for health insurance in this jurisdiction mandates a high degree of accuracy and fairness in claim adjudication, with specific provisions for handling complex cases and member appeals. Considering these factors, which approach to process optimization for claim submission and adjudication is most aligned with regulatory requirements and professional ethics? Option A. Implement a phased approach to automation, starting with simpler claim types, while maintaining robust human review for complex claims and establishing a clear escalation process. Option B. Prioritize speed of adjudication above all else by implementing automation without any human oversight, even for claims that appear unusual or deviate from standard patterns. Option C. Reduce the number of experienced claims adjudicators and rely solely on automated systems, assuming that technology will eventually resolve all adjudication complexities. Option D. Immediately deploy a fully automated adjudication system for all claims to maximize cost savings, with a post-implementation review to address any identified issues. The correct answer is A. Implement a phased approach to automation, starting with simpler claim types, while maintaining robust human review for complex claims and establishing a clear escalation process. Explanation: this scenario presents a professional challenge because it requires balancing the efficiency gains of process optimization with the imperative to maintain accuracy, fairness, and compliance in health insurance claim adjudication. The pressure to reduce operational costs through automation must not compromise the integrity of the claims process, which directly impacts member access to care and provider reimbursement. Careful judgment is required to ensure that any optimization strategy adheres strictly to the regulatory framework governing health insurance in the specified jurisdiction. The correct approach involves a phased implementation of automated adjudication for straightforward claims, coupled with robust human oversight for complex cases and a continuous feedback loop for system improvement. This strategy is justified by regulatory requirements that mandate accurate and timely claim processing, as well as the ethical obligation to ensure that members receive their entitled benefits without undue delay or denial. Specifically, regulations often stipulate standards for claim accuracy, appeal processes, and provider payment timelines, all of which are better served by a hybrid approach that leverages technology while retaining human expertise for nuanced situations. This method ensures that, while efficiency is pursued, the core principles of fair adjudication and regulatory compliance are upheld. An incorrect approach would be to implement a fully automated adjudication system without adequate provisions for manual review of complex claims. This fails to meet regulatory requirements for accurate adjudication, as automated systems may misinterpret or incorrectly process claims with unique circumstances, leading to improper denials or underpayments. Ethically, this approach breaches the duty of care to members by potentially hindering their access to necessary healthcare services. Another incorrect approach is to prioritize cost reduction to the extent that it leads to understaffing of experienced claims adjudicators, even in a hybrid system. This can result in delays and errors in manual reviews, again violating regulatory standards for timely and accurate processing, and potentially leading to member dissatisfaction and appeals, which are costly to manage. A third incorrect approach is to implement automation without a clear process for identifying and escalating complex claims for human review. This can lead to a situation where the automated system incorrectly adjudicates claims that require human judgment, thereby failing to meet the standards of accurate and fair adjudication mandated by regulations. The professional decision-making process for similar situations should involve a thorough understanding of the relevant regulatory framework, including specific provisions related to claim processing timelines, accuracy standards, and appeal rights. Professionals must then assess proposed optimization strategies against these requirements, considering both the potential benefits and risks. A risk-based approach, where automation is applied to lower risk, high-volume claims and human oversight is strengthened for higher risk, complex claims, is generally advisable. Furthermore, continuous monitoring and evaluation of the automated system's performance, with mechanisms for feedback and adjustment, are crucial for ensuring ongoing compliance and operational effectiveness. Question 18. Performance analysis shows a consistent trend of increasing claims processing times and a higher than anticipated rate of claims requiring manual review. To address this, the health insurance provider is considering several strategies to optimize claims cost management. Which of the following strategies best aligns with the principles of efficient and ethical claims handling within the regulatory framework? Option A. Focusing on renegotiating provider contracts to reduce reimbursement rates across the board, irrespective of the claims adjudication process, as a primary cost-saving measure. Option B. significantly increasing the threshold for claims requiring manual review, allowing a larger volume of claims to be processed automatically without thorough scrutiny to expedite turnaround times. Option C. Conducting a comprehensive review of the claims adjudication process to identify bottlenecks, streamline workflows through technology adoption where appropriate, and enhance staff training on policy interpretation and adjudication standards. Option D. Implementing a new automated system that flags claims with any deviation from standard protocols for immediate denial, thereby reducing manual review and associated costs. The correct answer is D. Implementing a new automated system that flags claims with any deviation from standard protocols for immediate denial, thereby reducing manual review and associated costs. Explanation: this scenario is professionally challenging because it requires balancing the imperative to manage claims costs effectively with the ethical and regulatory obligations to ensure fair and timely claim adjudication. The PHIAS exam context implies a focus on established professional standards and regulatory compliance within the health insurance sector. Careful judgment is required to implement process improvements that enhance efficiency without compromising the quality of service or the integrity of the claims handling process. The correct approach involves a systematic review and refinement of existing claims processing workflows to identify and eliminate inefficiencies, reduce manual intervention where appropriate through technology, and ensure consistent application of policy benefits. This aligns with regulatory expectations for efficient and fair claims handling, promoting prompt payment of valid claims, and minimizing unnecessary delays or denials. Ethically, this approach demonstrates a commitment to operational excellence that ultimately benefits policyholders by ensuring their claims are processed accurately and expeditiously, thereby upholding the insurer's promise. An incorrect approach that focuses solely on aggressive denial of claims to reduce costs fails to acknowledge the regulatory requirement for claims to be paid if they are valid and covered under the policy. This can lead to regulatory sanctions for unfair claims settlement practices and damage the insurer's reputation. Another incorrect approach that prioritizes speed over accuracy, leading to errors in adjudication and payment, violates the duty of care owed to policyholders and can result in overpayments or underpayments, both of which have financial and ethical repercussions. Furthermore, an approach that neglects to invest in staff training and development, leading to inconsistent claim handling and a lack of understanding of complex policy provisions, undermines the insurer's ability to manage claims effectively and ethically. Professionals should employ a decision-making framework that begins with a thorough understanding of the current claims process, identifying specific pain points and areas for improvement. This should be followed by an evaluation of potential solutions, considering their impact on cost, efficiency, accuracy, policyholder satisfaction, and regulatory compliance. Pilot testing of proposed changes and ongoing monitoring of key performance indicators are crucial to ensure that process optimization efforts are successful and sustainable, always prioritizing ethical conduct and adherence to all applicable regulations. Question 19. Implementation of a new remote patient monitoring program for individuals with chronic conditions requires careful consideration of several factors. Which of the following represents the most professionally sound approach to ensure compliance with regulatory frameworks and ethical best practices? Option A. Rely solely on the device manufacturer's privacy policy to govern patient data handling, without implementing additional organizational safeguards or obtaining explicit patient consent beyond initial service enrollment. Option B. Deploy remote monitoring devices immediately to gather baseline data, with the intention of addressing data security and patient consent issues retrospectively as they arise. Option C. Prioritize obtaining comprehensive, informed patient consent for all data collection and remote interactions, ensuring robust data encryption and secure transmission protocols, and establishing clear clinical protocols for integrating remote data into patient care plans. Option D. Focus primarily on the cost-effectiveness of the remote monitoring technology, assuming that regulatory compliance and patient privacy will be adequately managed by the technology's inherent features. The correct answer is C. Prioritize obtaining comprehensive, informed patient consent for all data collection and remote interactions, ensuring robust data encryption and secure transmission protocols, and establishing clear clinical protocols for integrating remote data into patient care plans. Explanation: The implementation of telemedicine and remote monitoring in health insurance presents a complex professional challenge due to the evolving regulatory landscape, the need to ensure patient safety and data privacy, and the imperative to maintain equitable access to care. Professionals must navigate these factors while upholding ethical obligations and adhering to specific jurisdictional guidelines. The correct approach involves a comprehensive strategy that prioritizes patient consent, data security, and adherence to established clinical protocols for remote care. This includes ensuring that all remote monitoring devices and telemedicine platforms meet relevant data protection regulations, such as those pertaining to health information privacy and security. Furthermore, it requires clear communication with patients about the scope of remote services, their rights, and the limitations of such care. Clinicians must also be adequately trained in the use of these technologies and understand how to integrate remote data into their overall patient management plans, ensuring that the care provided is clinically appropriate and evidence-based. This approach aligns with the ethical principles of beneficence, non-maleficence, and autonomy, as well as regulatory mandates for quality of care and data integrity. An incorrect approach would be to deploy telemedicine and remote monitoring without robust data security measures. This failure directly contravenes regulations designed to protect sensitive patient health information, exposing both the patient and the provider to significant privacy breaches and potential legal repercussions. Another incorrect approach is to proceed without obtaining explicit, informed patient consent for the use of remote technologies and the collection of their health data. This violates the ethical principle of patient autonomy and may also be a breach of regulatory requirements for consent in healthcare services. A third incorrect approach is to use remote monitoring data in clinical decision-making without established protocols for its validation or integration into patient care plans. This can lead to misdiagnosis or inappropriate treatment, compromising patient safety and violating the duty of care. Professionals should approach such implementations by first conducting a thorough risk assessment, identifying potential ethical and regulatory pitfalls. This should be followed by the development of clear policies and procedures that address data security, patient consent, and clinical integration. Continuous training and education for all involved staff are crucial. Finally, a commitment to ongoing evaluation and adaptation of these systems based on patient feedback, clinical outcomes, and evolving regulatory requirements is essential for responsible and effective telemedicine and remote monitoring integration. Question 20. Which approach would be most effective in optimizing the Children's Health Insurance Program, CHIP, enrollment and renewal processes while ensuring continued compliance with federal and state regulations and maintaining equitable access for eligible children? Option A. Implementing a significant increase in the complexity of required documentation for all new applications and renewals to enhance program integrity and reduce potential fraud. Option B. Broadening eligibility criteria beyond established federal and state guidelines to capture a wider range of children who may benefit from coverage. Option C. Conducting a comprehensive review of current enrollment and renewal workflows, utilizing data analytics to identify specific inefficiencies, and implementing targeted technological enhancements and staff training to address these identified areas. Option D. Shifting all application processing to a fully manual system with increased staffing to ensure personalized attention for every applicant. The correct answer is C. Conducting a comprehensive review of current enrollment and renewal workflows, utilizing data analytics to identify specific inefficiencies, and implementing targeted technological enhancements and staff training to address these identified areas. Explanation. This scenario is professionally challenging because it requires navigating the complex eligibility rules and enrollment processes of the Children's Health Insurance Program, CHIP, while ensuring equitable access for all eligible children. The pressure to optimize process efficiency must be balanced with the ethical imperative to serve vulnerable populations without creating undue barriers. Careful judgment is required to implement changes that streamline operations without compromising the program's core mission of providing health coverage to low-income children. The correct approach involves a data-driven review of the current enrollment and renewal processes, identifying bottlenecks, and implementing targeted technological solutions and staff training to address them. This approach is justified by the regulatory framework governing CHIP, which emphasizes efficient and effective program administration. Specifically, federal regulations under the Social Security Act and associated guidance from the Centers for Medicare and Medicaid Services, CMS, encourage states to adopt best practices for program integrity and beneficiary access. By focusing on data analysis and targeted improvements, this approach aligns with the goal of maximizing program reach and minimizing administrative burden for families, thereby upholding the program's intent. An incorrect approach would be to implement broad, sweeping changes to eligibility criteria without thorough analysis or stakeholder consultation. This would be a regulatory failure because CHIP eligibility is strictly defined by federal and state law, and unilateral changes could lead to the wrongful denial of coverage to eligible children, violating program mandates. Another incorrect approach would be to solely focus on reducing administrative costs by significantly increasing documentation requirements for applicants. This would be an ethical failure, as it creates an undue burden on families, potentially deterring them from enrolling their children and contradicting the program's purpose of expanding access to health care. Furthermore, an approach that relies on manual processing for all applications, even with increased staff, would be an inefficient process optimization, failing to leverage available technologies that are often encouraged by regulatory guidance for improving program efficiency and accuracy. Professionals should employ a decision-making framework that prioritizes understanding the existing regulatory landscape, gathering comprehensive data on process performance, engaging with stakeholders, including beneficiaries and program staff, and piloting any proposed changes before full implementation. This iterative and evidence-based approach ensures that process optimization efforts are both effective and compliant with legal and ethical obligations.